All right. Hi, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. Today, we've got the full team joining us, and we're going to spend some time talking through our recent scenario analysis that looks at potential outcomes of the unfortunate Russia-Ukraine conflict and tries to frame how some of the commodities we cover could move under some different assumptions. So to help discuss this scenario work we've done, I first want to call on Will Hares here. Will Hares is our senior energy analyst, and Will, you kind of helped come up with the basic notion of the scenarios we've used. So can you describe each one, and then we'll talk about some of the commodity implications with each of the team members here in a second.
Sure. Thanks, Rob. Yeah, so as you mentioned, our commodities team has contemplated three potential geopolitical pathways and outcomes for the ongoing war that Russia is waging on Ukraine. And we have broadly categorized them into three buckets. And we're calling them ease, extend, and escalate, as referring to the the geopolitical situation on the ground. And from these, we've assessed potential corresponding price scenarios for a bucket of commodities, including energy, metals, agricultural, over the next 12 months. So just quickly to frame each of the categories. Our ease scenario contemplates a near-term diplomatic solution. So this would see maybe a ceasefire, rapid de-escalation of conflict, full withdrawal of Russian military from Ukraine, resulting in a reversal of Western sanctions. But obviously, given what's occurred, we view this case as the least likely of our scenarios to pan out, given intensifying military aggression. We're seeing reports of war crimes being committed by the Russian side, and so it's probably the least likely scenario at this point. We see the reversal or easing of sanctions from Western allies at this point as pretty remote. Our extended scenario, this is our general base case, is based on the assumption of continuing conflict following Russia's invasion, with disruption of flows and the sort of sanctions status quo on Russian energy, which has seen select Western allies, the U.S. and the U.K., but has stopped short of the European Union. And also accompanies continued sort of self-sanctioning that we're seeing of Russian oil cargoes from traders, shippers, and banks, given regulatory or reputational risk. So this is our base case or extended geopolitical risk scenario, and our final escalation scenario is premised on a worsening of the on-the-ground situation in Ukraine, which includes potential escalation of conflict into direct engagement with NATO forces, and I think we're starting to see some evidence of this now. Potential war crimes that are being committed, which may force the West's governments to act on unfolding a heavy-handed or sort of maximalist economic response to isolate Russia as much as possible economically. And so this scenario would include direct sanctions on energy exports, oil and gas. We note that the European Union this morning is moving ahead with sanctions on or an embargo on Russian coal into the Union, and there has been suggestions from some of the leaders, including the president of the European Council, that oil and gas will follow, but they've been cagey on the time frame. Obviously, oil would be slightly easier to swallow than gas, for which the European Union is highly reliant on Russia at about 40% of demand. So those are our scenarios: ease, extend, and escalate. And I think that hopefully that provides a bit of context for some of the discussion that will happen now.
Thank you, Will. Fantastic framing. So hopefully we end up in the ease world from a health and security perspective, but we certainly have to think about some of the other outcomes that are possible. So, Grant, you have put together some outlooks for European steel, copper, aluminum, nickel, palladium under this scenario framework. And I realize each metal has its own distinct attributes, but can you give us a sort of broad sense of how you see the metals complex performing under these types of scenarios we'll just put forward?
Sure. So thank you for that, Rob. So in my analysis, I've had to consider, I guess, the varying degrees of which Russian metal supply would be restricted, because Russia is quite an important producer of metals. So it ranges from palladium, which is close to 40% of global supply, nickel around about 9%, aluminium 5 to 6%, and copper down at sort of 3%. So it's a fairly significant provider of metals to the global metals market. So we have to take that into consideration. A second derivative is how, let's say, energy does get restricted into Europe, how that will impact Europe's metal output, and particularly something which is very energy intensive, like aluminium. That would be a sort of a second order impact of sanctions. And then lastly, as we all know, in commodities world, high price, the cure for high prices is high prices. So in some of those metals, we'd have in all of them, arguably, we'd have some demand destruction. And then we would have to sort of think about, okay, but how does China respond in this world where high prices really sort of dampen down global economic growth? China, we would argue, would respond quite positively and stimulate quite aggressively to offset that. And putting all of those sort of four things together, in general terms, in each of those scenarios, under the E scenario, we thought metal prices would pull back. On the extend scenario, we thought mostly metal prices would kind of stay where they are, and they'd rallied quite sharply, and we thought they would be able to hold at that level by and large. And then in the escalate scenario, we thought there was some further upside to where metal prices were going. And if we take aluminium, for instance, it's trading at around 3,400. That's just slightly above our extend range, but a little bit below the upper end of our escalate sort of range. So that's where most of the metals are sort of trading by and large. I guess, and that was, although that was on the assumption that some of the metal flows do get rerouted, probably via China. China plays a bit of a holding role. In other words, it sort of drip feeds metal to the rest of the world. So that provides a bit of price tension. There is demand destruction, and this is where the key difference came into play. So something like aluminium is arguably used in a lot of different applications, and it's quite difficult to substitute. So we thought that yes, there may be some demand destruction at the margin, but it probably wouldn't be that extensive. Metals such as nickel and palladium are not easily, but can be substituted. So particularly in nickel, it's used mostly in stainless steel. You can very easily switch to nickel-free grades of stainless steel. And we've seen this happen in the past, particularly in the 2007 spike when we saw nickel rally well above $50,000 a ton. So we felt that would actually sort of almost flip on its head, and we thought that the E scenario would probably be better for those metals because there would be less demand destruction, whereas the escalate scenario would actually be the worst outcome. Now that might not play out over the next couple of months. We might see elevated prices, but that very quickly would lead to quite a lot of substitution and demand destruction.
So, Grant, I want to follow up on the idea of substitution because in the energy segment, there is a real serious discussion in Europe about dashing as quickly as you can to wind, solar, nuclear. When you think about the wind segment, there's a lot of steel involved in producing a wind turbine. About 70% of the mass is steel. So does the move that's happening in the energy segment, how does that feed back into your view of demand, and is it counterbalanced in any way by slower growth in China or other factors? How do you kind of level things out when you know you've got definite things happening on the energy front?
No, so that's a very good question. So if we take steel as an example, in the bullish pricing scenarios that we envisaged, there was exactly that, a counter sort of balancing between demand. So arguably, we would say in the more consumer-driven applications, you may see the demand destruction. So in steel, for instance, maybe if prices of autos had to be bumped up to levels where people felt uncomfortable, that was where we would see the demand destruction. Maybe in consumer durables, you can postpone buying a car or a washing machine for a year or so. But on the flip side, the more of the infrastructure, let's say government-sponsored, indirectly or directly projects, such as wind and the energy transition, that would be the positive driver. So overall, even in the sort of extend escalate scenario that we came up, we thought demand would stay pretty robust or stay reasonably strong because of those counterbalancing factors. So it's a very, you raise a very important point, and it's not too dissimilar for something like copper, and perhaps even aluminium.
Okay, so with that idea, I want to bring on Salih Yilmaz to share some thoughts on the oil industry. If you haven't seen it yet, Salih has a new focus idea out on the potential supply-demand balance and a potential deficit in 2Q, and it was a collaboration with Will Hares. It's just out this morning. And Salih, I kind of want to frame it to you in the same way. What's demand response potentially look like over the next 12 months in the oil space, and how does that contribute to your thinking on the overall balance?
Sure. Thanks, Rob, and thanks to Will for framing the scenario. So I'll briefly walk you through what our kind of price expectations are in these three scenarios. And then I think the question you ask on demand and demand destruction and how that compares to metals, perhaps, I think is a really good one. So I'll try to mention that as well. So in the easing scenario, we see oil prices getting closer to about $90 a barrel, which is around the level where we were before the Russian invasion of Ukraine. So essentially in this scenario, we see that geopolitical risk premium that's been added to oil prices kind of wear off over time. But I should say, as Will mentioned, we don't see this scenario as we see this scenario as is probably the least likely one to unfold. And I should say that even if it happened, we had ceasefire and we see oil prices go down below $100 a barrel, I should mention, and I think I will go on to when I talk about my focus idea, we are still looking at very strong fundamentals for the oil market. So we don't see oil prices staying at around $90 a barrel beyond kind of the near term. In the extended scenario, we see oil prices closer to $120 a barrel. And we're not quite there yet. I mean, when we look at Brent price, it is below $108 a barrel this morning. We're not quite there yet, and I think market has not really digested, and getting timely data on how much disruption there is to Russian oil flows is pretty hard to come by. So, but as I think the market sees how much disruption we're seeing from Russia, we will probably we might get oil prices closer to our extended scenario. And then finally, in the escalating scenario, we see oil prices at $160 a barrel or more. And this is obviously a scenario where we would see more and deeper sanctions on Russia. We would see disruptions to oil flow outside of Russia, from Russia, at 3 million barrels a day or more, which is much higher than what they are at the moment. So to your question about demand and the kind of the demand response, we haven't quite seen too much of a demand destruction yet in the oil market. And I should say that's partly because as we've seen oil prices above $100 a barrel, this is obviously too high at the pump in some countries. So what we've seen in countries from the US to UK, from New Zealand to Japan, have been cuts to oil taxes and some subsidies. And what this does is it actually boosts demand, and it actually delays any kind of demand destruction that we perhaps will see at some point for oil. So with all that in mind, when we kind of link that to the balance as we see it in the oil market in the next couple of quarters, we actually see a deficit brewing in the market, at least in the second and third quarter. And I know this is in contrast to some of the expectations from agencies such as OPEC themselves and the EIA. But we think, I mean, these agencies will eventually revise their estimates for where they see the oil market, because when we look at the potential kind of losses of Russian barrels given sanctions, and as I said, I mean, our base case scenario implies that we might get, sanctions unfolding and actually disrupting Russian oil flows a lot more than they perhaps did in March. And then at the same time, for OPEC, we have most member nations struggling to increase supply. And on the demand side, we're not seeing much of a response. So when you combine all of that together, we see a deficit in the market through summer. And what this means is, if this unfolds, if OPEC turns around, if EIA turns around and says, actually, we may have overestimated the surplus that we see in the market, this is obviously going to put upward pressure on oil prices. So we continue to see risk skewed to the upside for oil in the next few months.
Salih, if we get up to the 160 plus price per barrel range, does that accelerate EV adoption, or are EVs still less economic at that price level?
No, I mean, it must do, right? And I mean, our argument, not just for EVs, but for the energy transition, I think the Russian invasion of Ukraine is probably going to accelerate that. Much higher oil prices. I mean, if you ask, I mean, at a consumer level, I think we haven't done the survey, but we probably should. If you ask many people what their next car will be, I think more will now say that it will be an EV or a hybrid compared to before. So, I mean, and that's part of the demand destruction, right? Again, we're not seeing it yet, but I think if this unfolds and we are at much higher oil prices, I think this only pushes EV adoption to accelerate. Again, I mean, this is something that we talked about here before. I mean, EV adoption is something that's already happening, but this is not something that's going to destroy demand overnight. I mean, we still have a car fleet that's more than 1 billion, and it will take time for EVs to be a much higher share of the total car fleet, which is when we will see a lot more demand, this being reflected on the oil demand side of things. But again, this will, I think, only accelerate things, and this is probably gradually going to happen at current prices too. It's not necessarily going to be at $160, $180 a barrel, but that would only accelerate it, I think.
Fantastic. Okay, so let's switch gears just quickly and come over to Patricio Alvarez, who covers utilities and the gas market in Europe. We've already got the sense, Patricio, that there's all kinds of dynamic things happening in the metal space, in the oil market. What's going on with gas? How tight is the supply-demand balance in your view? And what kind of efforts are being undertaken to substitute away from what is arguably quite expensive European natural gas right now?
Thanks, Rob. So I think a good way to start or to give some context is that we were so far the easing scenario would be going back to pre-invasion of Ukraine. We would see gas prices at about 70 to 80 euros per megawatt. And that just reflects what the market conditions were prior to the invasion. These were already very tight. We were seeing storage levels depleted below their 5-year norm in Europe. And this also combined with the lower Russian volumes, which remained subdued by about 40% throughout 4Q last year. So that was the let's say the base case scenario back then. Now post invasion, we are living through the extend scenario, and we've been so far on the mark at about 100 to 130 euros per megawatt, which is about 6 to 7 times the 5-year historical average for European natural gas prices. And this, I think that the thing that's worth highlighting, at least from my point of view, I expected gas prices to somewhat ease after the ending of the heating season, which finished in March 31st. That's because we would have enter the shoulder season before the refilling or reinjection season, which is the summer months, and we have so far seen no movement in the gas prices. We're still at about 108 euros per megawatt at the moment. And this is, I believe, just a looming geopolitical risk. This, I think, is where gas is very different to oil, where Salih was mentioning that the geopolitical risk premium seems to have eased. In gas, we don't see that sort of elasticity, just because there's a looming risk, at least in my view, that as long as this conflict extends, there will be more of a chance of a disruption from Russian gas, either from the inclusion of gas into the sanctions or retaliatory cuts, as we've seen already. The nationalization of Gazprom's retail arm in the UK and in Germany. These are the type of moves that could prompt some type of retaliatory response. And on the second part of your question, as into what are the alternatives to shift away from this dependence, we saw obviously an acceleration of renewables would be the structural fix, but this would take at least through mid-decade to make a significant contribution. As you wrote in your note, Rob, it would take at least 3 or 4 years for solar capacity to make a dent in power generation for gas use, and the rest. There's some alternatives to gas in terms of coal switching, but power generation demand for gas could somewhat be alleviated over the next 2 or 3 years. But I think the immediate consequence of the suppression of gas supply would be significant demand destruction. We've already been seeing this. We saw this in the fourth quarter with industrial curtailment in Germany. And we've also seen incumbent participants in Germany, such as RWE and Uniper, flag that demand destruction for industrial begins at about 70 euros per megawatt. And I can't emphasize enough, we're at 110 euros per megawatt, which is nearly 6 to 7 times as much as we are used to. So yeah, with that, I'll close it.
Okay, thank you very much, Patricio. Okay, I want to come over to Will Hares. You've got a focus idea that really looks at a company that is particularly levered to the outcome in the gas market. We've talked about it on this call before, but can you give us an overview of your thesis on Equinor? And for anyone who hasn't seen it, focus ideas are our most differentiated, highest conviction views on the market. We've got several related to the Russia-Ukraine conflict and kind of potential outcomes there. So over to you, Will. Tell us about Equinor real quick.
Sure. Thanks, Rob. So my focus idea on Equinor is really quite straightforward. Equinor is the second largest gas supplier to Europe after Russia's Gazprom. And so we think the company is uniquely positioned to capture value from the prevailing commodity price backdrop for European gas. And just to put it out there, we had published this well prior to the Russian invasion of Ukraine. It was mostly based on the fundamentals we were seeing in the gas market, very tight, and at the time we were approaching record low European storage. And on top of that, Equinor is doing everything it can to optimize its gas production on the shelf. This is as they are one of the key suppliers, and they are doing everything they can to maximize their exposure to this pricing, for which they have a lot of spot pricing exposure. So this is really one of the best options that we think for hedging against spiraling geopolitical risk and inflationary pressures as a result, just given its extremely unique position on the continental shelf of Norway, and with the gas volumes that it has, and against some of the risks that Patricio just went over, potential retaliatory cuts from Russia, maybe in response to the West strengthening sanctions. Whether that's directly on other forms of energy or banning Russian banks from SWIFT. So we our focus idea is based on that the consensus estimates are significantly undervaluing the company's value capture from the gas price environment, and we think 2022 EBIT for the company will handily beat estimates. So it's one of the most interesting companies as it pertains to the ongoing crisis in Ukraine.
Thank you, Will. Okay, so along these same lines, I want to bring on Darja Lema. If you don't know Darja, she's an associate on the team, and she's recently picked up coverage of some of our Eastern European refiners, including PKN. So Darja, what's your sense on how are they responding to the conflict? How is it causing changes in the way they're trying to manage how they source their oil?
Yeah, thanks, Rob. So PKN is indeed among a few names which are most exposed to Russia with regards to potential Russian embargo on oil. So more than 50% of crude is coming from Russia for Finnish Neste, Hungarian MOL, and Polish PKN and Lotos indeed. And so, as we mentioned, I would like to highlight Polish refiner PKN here. Prior to Russia-Ukraine crisis in 2022, PKN actually expected to receive about 50% of its crude from Russia, including 31% secured through fixed contracts with Rosneft and Tatneft. However, now, since the beginning of conflict, they have continued to receive the crude through fixed contracts. However, these crudes have been coming at extreme discounts, while the remaining 70% has been coming from Saudi Arabia, the US, and most recently Norway, where crude vessels were shipped directly to Lithuanian refinery located on the Baltic coast. Going forward, Saudi Arabia will likely become the largest supplier of oil to PKN, given its prior agreement to supply up to 45% of PKN's oil needs, agreed back in January. So having said all of that, we believe in a case of potential oil embargo from the EU or any other country in Europe, PKN should be able to secure the alternative sources of oil supply.
And Darja, what's your sense? Is the current commodity environment, how are margins holding up for some of these kind of refiners? Are they able to, is this positive? Is this margin positive or margin negative if you've got a sort of elevated oil benchmarks like we're seeing?
So we are seeing elevated oil benchmarks. However, if you're buying crude from Russia, we've seen extreme discounts coming from Russia. We have seen the Brent Ural differential of about $30 a barrel in March. This is significantly higher than we saw $5 a barrel differential in February. and also the elevated fuel prices in diesel and in gasoline have been supporting the extremely high refining margin for the last couple of months. So we believe these kinds of levels of refining margins should really boost the profitability of refiners in Europe.
Thank you, Darja. We're going to run over for a few minutes, so anyone who wants to stick with us, we'll have a little bit more Q&A here. These calls are pretty informal. We get together on the first and third Wednesday of every month. We don't typically have slides. We are talking about all of the research that we publish, which is all available on the terminal. So feel free to join us every other Wednesday, more or less. But and we normally try to keep it tight at 30 minutes, but we've just got so much to discuss today. So, Salih, I want to come back to you. You've got a pretty interesting chart in your focus idea. Again, if you haven't seen it, go to BI Go. It's there. And probe you a little bit more on the same kind of idea, for the oil market generally. How easy would it be to make up for the sort of potential or estimated disruption of Russian crude supplies that have been making their way onto the market? I think it's like your second exhibit. You've got some nice way of framing it. So talk us through your view.
Sure. I think it's a very good question, and the short answer is no, it is not easy. And it's not just because of the volumes, but not every crude oil is created equally. I mean, it comes in different grades. Some are light, some are heavy, some are sweet, some are sour. So it's not just about filling in for the amount. It also matters where that crude is coming from. But that aside, it's just very difficult in this instance because, as I mentioned earlier, we were already in a very tight market situation. So, if you're losing 1 million barrels per day, or in worst case scenarios, we're losing 2 or 3 million barrels per day, the way we could fill this in could be, when we look at global oil spare capacity, we have in the Middle East Saudi Arabia and the UAE, which are really the only two countries with notable spare capacity. And so they could probably fill in for almost 2 million barrels per day. But the issue is, what we've seen in the last couple of OPEC meetings is that they've made it pretty clear that they do not want to do that, because what they did in the last couple of OPEC meetings, despite pressure, was to kind of reaffirm that they will only increase by the initially planned amount of 400,000 barrels per day, which obviously doesn't really make a dent when you have so much disruption from the Russian oil flows. And the argument there was, and I think this is arguably an okay argument, is that even if they increased by as much as they can, then we are in a scenario where we have almost zero spare capacity, which is also quite bullish, right? Because we then have no barrels left to respond to any other further disruption that we know happens in the oil market. So one is OPEC response, and in our charts, and I'm happy to share this, this is the third chart in my focus idea. I'm happy to share it after this call. But there is the OPEC response that we would have as a tool that we know is not going to happen. The other one is strategic reserve releases. And we know we've gotten some details on what the U.S. wants to do. What they said is they want to do a 180 million barrel strategic reserve release, which could be about 1 million barrels per day for the next 6 months. Although because of technical and logistics issues, arguably they couldn't even deliver the 1 million barrels per day. But that's one thing we can do. And we know IEA also said at a global level they would be ready to, because they have a lot of reserves, especially in the OECD countries, they would be ready to do a similar strategic reserve release. But very important, I think, and perhaps not discussed enough, is similar to how you can increase supply, but then you have no spare capacity left. What would happen with the strategic reserve release is this is really a short-term and a band-aid solution to a long-term problem, because you could be you could be doing this just to fill in for the short-term kind of undersupply, but then you have less stock, less inventories left in the mid to long term to respond to any disruptions in the futures, which could, again, very similar to having no spare capacity, could be seen as a bullish indicator. So that's why, and this is what this chart is trying to show, is that we really only have a couple of tools which are probably not going to be that effective and are really short-term solutions to a long-term problem.
Okay, thank you very much, Salih. I think that will probably be where we need to end it today. We could have had a deep discussion on any one of these topics, so I appreciate everyone's time. Follow up with any of us individually if you want to learn more, have questions about anything we've said. We have another formal webinar coming up in about an hour and a half at 3 p.m. London, based on some research that Will Hares, Grant Sporre have done on industry capital allocation, how cash is being used these days. So check out their notes. Please feel free to join that event. You can find it on SEMR, and if you can't find it, shoot any one of us in IB. We'll help get you pointed in the right direction. We'll hold the next one of these in 2 weeks' time on April 20th, losing track of where we are. And again, thank you for your time, and we hope to hear from you soon. Have a great rest of your week, everyone.